Well, thanks for that. And we're almost closing down on day one at the JP Morgan conference here in Mumbai. And who better than James Sullivan himself right here with us to give us some color on how day one has been and what's lined up for day two as well. James, welcome to ET now. Quite intrigued to know what are the questions about India. There's so much push and pull happening with us at both ends.
No, as you very rightly say, I think it's a very unique time to be looking at the Indian market for a couple different reasons. On the macroeconomic side, there are statistics really pointing in both directions. From a markets perspective, though, I think the outlook is a little bit clearer. The nice thing about markets is ultimately it's about pricing in various versions of the future. At the moment, because of significant market underperformance relative to the rest of Asia, because of currency underperformance, but also critically, as we were discussing prior to the program, the fact that earnings expectations have been significantly reduced, we're at a stage where we think entering the Indian market from an equity perspective right now makes a lot of sense. The risks are skewed, we would argue, asymmetrically to the upside because expectations have been lowered significantly.
But is the tariff disruption in the price?
Look, I think it is. If you look at how the tariff disruption potentially filters through the Indian economy, there's a couple of things to think about. So the headline is 50%. If you adjust for excluded items, however, you're sitting at 34, which is still a relatively high number, but not nearly as high as the headline. And then if you look at the opportunity for Indian companies to diversify and relocate those exports over time, we do think that the economy has the ability to adjust and to stomach some of the impact. The other reality, however, though, is that the Indian economy is far less exposed to export as a driver of the overall economy, at least on the good side, relative to most of the rest of Asia. And so on a relative basis, if we're trying to understand the impact, India actually looks reasonably good because goods exports are not the driver of the economy. It's really been the services side that has been most interesting.
And you think services getting interrupted because of the recent visa fee hike?
I would look at it a little bit the opposite way, actually. I mean, if you think about it very, very simplistically, you've had 2 decades where foreign companies have hired Indians and moved them to the U.S. Now they'll hire Indians and leave them here in India, right? Like JP Morgan has 20,000 people here in India. And so the argument that this fundamentally changes the nature of the services conversation in India, I disagree with. It might change some element of the exportation of services, but if that requires more Indians hired and left on shore, that's not necessarily bad for anybody.
That's a model for anyone to look at, U.S. companies and others?
So 2 components to my answer. Number one, the idea that the world will continue to leverage India as the office of the world, I think, is still a very compelling conversation and drives a lot of investor interest in this market. The other side of the equation is the devil is always in the details, and at the moment we have almost no details in terms of the implementation of this policy in the United States. And so we'll have to see how this actually rolls out in practice versus in tweet or headline. But the overall message is that we think that India as the office of the world is still a very compelling thematic moving forward.
Sure. James, as this disruption plays out, either where Indian companies set up shop in the U.S., or a lot of the Indian workers who were in the U.S. set up shop back here, that disruption is going to come at a cost. And that's something that the equity markets would have to factor in a jiffy.
Yes.
So if I'm building an India portfolio right now, what should be my sector? Overweights, underweights,
Sure.
So much flux. How do I price that all in?
Sure. I think so. The easiest way to construct an overall India-focused portfolio right now, at least from a JP Morgan perspective, is to really key into demand that is driven by domestic forces and storylines that are more under control of the Indian government or Indian corporates than exposed to international decisions over which we don't know what's going to happen. And so if we think about the fact that we just saw a very good second quarter calendar year, first quarter fiscal year here in India, GDP print at 7.8%. JP Morgan's taken up our full year economic growth forecast off that print. Monsoon, as we can see outside today, doing quite well, 7% ahead of historical averages.
Stretch there, stay.
Exactly. Well, you never know. That plus the typhoon in Hong Kong, people might be here for a while. The point, though, is that you see multiple drivers of incremental demand, particularly in rural India, which is a core line of analysis that we've continued to focus on. So you have a combination of a better-than-expected monsoon, reasonably good macroeconomic backdrop, paired or tripled with the GST rate cut that the government just pushed through. You have multiple idiosyncratic drivers of rural demand, consumption demand here in India that have nothing to do with the broader trade conversation. And so really keying into those sectors, so consumer staples, consumer discretionary, financial services is something that we've been very focused on.
The foreign flows, which are actually a negative for us.
Yes.
And you've listed a lot of positives which are coming in with respect to consumption, with respect to the models that could go for services and others. When do you think global funds are going to look at India as one of the countries?
Great question, and they haven't been slightly negative. They've been $23 billion negative
yeah.
for FIIs over the course of the last 12 months, and so that's a big number. The critical element from our perspective is always watch where the market starts. And if I look at Asian market performance this year, you have India being a dramatic underperformer after relative periods of outperformance historically. You have the Korean market up 50% after a truly abysmal 2024. And so that starting point is absolutely critical. And so you've seen the sell down by foreign investors. Why did that occur? You had a confluence of India becoming relatively expensive relative to regional and global peers at the same time that you saw a stalling out in terms of earnings forecast revision. And so we had actually downgraded the Indian market too early, in hindsight, off the back of that downward revision in corporate earnings. Now that revision cycle, we feel, has bottomed. And so the street's already sold. Valuations are now regionally attractive. Earnings expectations are imminently beatable, which is a very strong setup for incremental performance.
So if you look at the valuation, the relative valuation has remained the same. It's the Asian valuations which have gone up, right?
Exactly.
In that sense. So from a foreign investor's point of view, how do you look at this entire thing? Even if India is underperforming the Asian markets in that?
So the valuation conversation in India is a slightly longer one, but I think the fascinating aspect of it, ultimately valuations are premised in the value of money. And the differential conversation here in India relative to a lot of markets around the world is the fact that you're seeing a structural reduction in the cost of money in India as interest rates have started to structurally come down. And we had the deputy RBI governor on stage talking about this earlier. That arguably sets the stage for a higher overall valuation metric here in India. And so one of the things that we caution investors about a lot is now relative to 10-year historical average, I don't really care, because that average was based in a set of macroeconomic and microeconomic statistics which may or may not be relevant today. And so if I look at India's relative valuation to the U.S., to other markets around the world where you're seeing rate structures go up versus rate structures here go down, that absolutely matters in terms of those relative valuations.
The domestic flows is playing a big important role, and
Absolutely.
it's not allowing your valuations to come down either, right?
Absolutely, and so you've seen $23 billion in FII outflows. You've seen, I think it's $93 billion in inflows.
Yeah.
Now, why isn't the market up off of that differential? Because a lot of that has been soaked up by new issuance. But again, that's a very positive side for the Indian economy. It's a very positive sign for the maturation of Indian equity markets as the broader segment of the Indian population starts to participate and really benefit from the upside in the overall market.
But James, if I were to just sort of zoom out of India and look at the whole globe as a picture, you think the trump card, and no pun intended here, lies in the way the dollar is going to move? Or is it going to be more about Fed action?
So they're interlinked by definition. I think if we take a step back here in Asia for a second, one thing that we haven't talked about is there is a reality in Asian markets where it is very, very rare for both India and China equity markets to work at the same time. And so one of the dynamics that we very frequently see is this rotational trade within Asia. The reality is China got very cheap. You started to see positive earnings revisions. You started to see policy impetus across a range of sectors that has driven significant outperformance for Hong Kong, China, A, H, et cetera. Now, to some degree, that comes at the expense of India, as you saw this rotational trade kicking in. Now we're at a situation where China has outperformed, India's underperformed, expectations have gone up, expectations have come down. Again, one of the things I love about my job is this search for asymmetry. And we really feel that that's starting to come to the fore here in India right now.
And how exchange-traded funds have been invested into China, Korea, and other Asian countries. Do you see a reversal of trade happening at that?
We'll have to see. From a broader asset allocation perspective, one of the key dynamics that we see on the ETF side is really this dynamic where ETF fund flow comes into a market, and this has been true here in India as well, and it effectively floats the top end of the market away. And so if you look at the valuation gap between large caps and mid and small caps in a lot of Asian markets right now, that's gapped out because of the ETF flows. The dynamic that we pay attention to here in India is from a research coverage perspective, we're seeing a significant broadening of investor interest past the mega caps and into the mid and small cap space. And so we're expanding coverage here in India. We're actually making 2 offers this week for incremental analyst hires and continuing to invest in this market.